Lauren and Anthony had recently ventured into the world of real estate by purchasing an investment property. They were excited about the potential for additional income but knew that understanding the tax benefits was crucial to maximizing their returns. Lauren and Anthony, a young couple with a knack for smart investments, had just bought their first investment property. While they were confident about managing their new rental, they were eager to learn how to optimize their tax returns to get the most out of their investment. Anthony, did you know we could deduct the mortgage interest on our investment property too? Lauren asked, browsing through an article. Really? I thought that was only for our primary residence, Anthony replied, intrigued. Lauren explained, no, it applies to investment properties as well. Plus, there are other deductions we can claim, like property taxes, insurance, and even certain home improvements. For instance, mortgage interest paid on the home loan is often deductible, and property taxes typically provide significant relief. Anthony nodded, starting to see the potential. What about the costs of managing the property? Things like advertising for tenants or hiring a property manager. Lauren smiled. Yes, those expenses are deductible too. Essentially, anything that directly relates to maintaining and operating the property can be written off. If we work from home to manage the property, we might also be able to deduct a portion of our home's expenses, including utilities and rent. Lauren continued, for example, if we replace the old roof, the cost can be deducted as a capital expense over time. Any repairs we do, like fixing a leaky faucet or repainting, are deductible in the year we pay for them. Certain home improvements, like energy-efficient upgrades or accessibility modifications, might even qualify for tax credits or deductions. Anthony was impressed, so by keeping good records and understanding these deductions, we're essentially boosting our long-term profitability. What about state and local taxes? Lauren nodded. Depending on our location, state and local taxes might be deductible from our federal income tax as well. Even premiums for homeowners insurance and homeowners association HOA fees might be deductible. And don't forget about private mortgage insurance PMI. Some countries allow deductions for PMI if you have a smaller down payment. Anthony was excited but cautious. This sounds great, but isn't there a lot to keep track of? Lauren reassured him, yes, but it's worth it. Think of it like this, by maximizing these deductions, we're effectively increasing our net rental income. It's like getting rewarded for being thorough and diligent. Lauren remembered reading about depreciation. And don't forget about depreciation. We can deduct a portion of the property's cost each year, spreading the cost over 27.5 years. This can significantly reduce our taxable income. Anthony was impressed, so by keeping good records and understanding these deductions, we're essentially boosting our long-term profitability. But isn't it complicated? Anthony asked. Lauren shook her head, not really. It's about staying organized and possibly working with a tax professional. They can help ensure we're claiming everything we're entitled to and keeping us compliant with tax laws. Over the next few months, Lauren and Anthony diligently kept track of their expenses and sought advice from a tax advisor. When they filed their tax return, they were thrilled to see significant savings. Their investment property was not only generating rental income but also providing substantial tax benefits. Inspired by their success, Lauren and Anthony encouraged other homeowners with investment properties to do the same. Take the time to understand the tax benefits of owning an investment property. Keep detailed records, make necessary improvements, and don't hesitate to seek professional advice. The savings are real and can make a big difference.